All right, welcome you guys to our workshop today. Great, thank you, Brad. Awesome, hurrah. Uh, really looking forward to spending the next little bit with you today. This is a masterclass workshop. This is not going to be light material. We are going to spend the next hour and a half, 2 hours together, really digging deep into this concept of following the smart money. So, how many of you here today have heard about or had somebody mention or had actually learned about following the smart money? Go ahead and say I, or if this is a brand new concept to you, go ahead and put new in the chat. Awesome, Raymond. Great, Brad. Great trader. Awesome. We got a couple of new people. Great, good to have you here from Charlotte, Florida. I'm just here in Tampa myself. All right, we've got a huge group here today. This is designed to be interactive, so make sure you find that chat because that's going to we're going to be very interactive. So we're going to start off this morning. Depending on where you're tuning in from, it may be afternoon. It is for me. We're going to do a little bit of trivia, and for the person that gets this right, we are going to send you a crisp $100 bill via Amazon to spend how you would like. Nice, Africa, holy smokes. So go ahead and find the chat and let me know. We've got a huge group here today. Let me know that you find the chat and say ready. We're going to do some trivia. So put your trivia cap on. You're going to get $100. The first person that gets this, we're going to send you $100. Yeah, we're going to, yep, that is the chat box there, trader. And now I don't know that you guys can see Trader's chat is still not available. I'm seeing your guys' messages here. Let me just take a screenshot of it just so that you can see.
For the attendees, the chat box is the questions box.
Yeah, for attendees, the chat box is the question box. I'm seeing your stuff, so if you're not seeing other people's comments, then we are seeing them. Yep, that's it, Brad. That's it. Great, Pablo. I see your stuff. All right, so we're going to go ahead and get started here. Great, Van. So for those of you that are here, let's put our trivia cap. You're right, it's not a chat box, it's a question box, but that's where we're going to do our comments at for the session today. All right, ready? All right, who is this? I'm going to give you some clues. Who is this? 8 years after starting my hedge fund from my dorm room, I had lost tens of millions and went totally broke. Trader says the Grinch. Brad says Nick. Nope, not quite. Not me. All right, we've got a huge group here. We're doing some trivia. For the first person to get the answer to this question or figure out who this is gets $100. Trader says Bernie Madoff. Nope. Nope. All right, so 8 years after starting my hedge fund from my dorm room, I lost tens of millions and went totally broke. Nobody has it yet. All right, here's another one. I lost so much money I couldn't afford to make ends meet. I even had to borrow $4,000 from my dad until I could sell our second car. Wayne says Jeff Bezos. Nope, good guesses. Good guesses. Not me. Not me. All right, who is this? Nobody knows. I really want to give out this $100. How about I give you a huge hint. Oh, Trader says Ray Dalio. So whoever that is, Trader, can you go ahead and so you can see here, he was the very first one right here. Ray Dalio is the answer. He is the founder of Bridgewater Associates. So Trader, if you can, please send me an email with your whatever email is connected to an Amazon account of yours. My email is Nick, N-I-C, at thesupertrader, just how it's spelled out like that, .com. And just say that I was the trivia winner, and we will get that to you. Brad says congrats. He's spot on. This is Ray Dalio. This is Ray Dalio, and he is the founder of a hedge fund called Bridgewater Associates. I went ahead and put my email address in there, Trader, so that you've got that in the question and answer area. This is Ray Dalio. He founded Bridgewater Associates out of his dorm room. I start this way because I know a lot of us have been doing this for a long time. And I just want to start off by kind of introducing his story, because I think that there are some relevant lessons that we can learn from him. It's a little bit difficult to connect to this kind of individual nowadays because of how large of an institution he has built. But there's some really good lessons to learn here. So Ray Dalio, he started this fund in his dorm room, and it wasn't about 4 years after starting that he went totally broke, lost tens of millions of dollars. But looking back in hindsight, his fund, he's been able to grow it to the largest fund in the entire world. It's also the most profitable hedge fund in the world. And just to give you a glimpse or a look at the sheer size of how large this fund is, 0.1% of $160 billion under management is still 160 million. Most of us would be quite satisfied with something even a quarter of that size. So this is a monumental success, and it wasn't something that was just handed to him on a platter. In fact, he had massive setbacks, and a lot of us have that as well. And so I just want to kind of go over this in the beginning, because wherever you're at and however long you've been doing this, it's probably not the case that you've lost tens of millions of dollars. And I think that it's helpful to recognize that there's still hope, and you can still get this done in the way that you want to get it done, just like Ray Dalio did. Because looking back, it looks like, if you just look at Bridgewater Associates, it looks like they've just had a charmed, successful experience in the market. But that's not the case. He said that 8 years after starting my fund, I had lost tens of millions of dollars and went totally broke. Now, the way that this happened was in 1982, he had predicted that the market we were going to be heading into a depression, and he ended up shorting the market in a big way. He says, I was dead wrong. The stock market began a big bull run, and over the next 18 years, the U.S. economy enjoyed the greatest non-inflationary growth period in its history. He said that being so wrong, and especially so publicly wrong, was incredibly humiliating and cost me just about everything I had built. And I think that lots of us could probably connect to this. He says, my experience over the period was like a series of blows to the head with a baseball bat. How many of you have ever felt that way? Like, your experience in the market is like a series of blows over the head with a baseball bat. How many of you have ever felt that way? Say I. Say I in the chat if you've ever felt like sometimes it's just like getting beat over the head with a baseball bat. You just keep being wrong. Van is one of the truthful ones. He says I. Lots of us. I. Trader Brad. Okay. This is an experience that a lot of us have, and you know, it's embarrassing while we're going through it, and we feel like, hey, we're better than this. I've taken the training, I've gone through the School of Hard Knocks, and I just can't seem to get this. Some of you probably have not been in this situation yet. Maybe you have, but he had lost so much money that he had to even borrow some money from his dad just to make ends meet. Brad says, I haven't lost 10 million yet, so that's good, right? I love the looking back, and that's what my goal here is today, is to accomplish some thoughtful reasoning with a group of folks who we're all on the same mission. And Ray said that he saw clearly that the best way to increase my probability of being successful is by finding other independent thinkers who are on the same mission as me and who see things differently from me. By engaging them in thoughtful disagreement, I'd be able to understand their reasoning and have them stress test mine. So that's what we're going to do today, because the reality is that whatever you've gone through up to this point, no matter how difficult it is, there is a price that has to be paid to be able to compete on a high level in the markets. And one day, my hope is that from at least, you know, the little contribution that I may be able to have on you today with the things that we're going to talk about, my hope is that soon you'll be able to look back like Ray did, and he said that in retrospect, my crash or failure was one of the best things that ever happened to me. I saw that to do exceptionally well, you have to push your limits, and that if you push your limits, you will crash and it will hurt a lot. You will think you have failed, but that won't be true unless you give up. So my, I guess, spirit of this workshop today is that you will look at your failures prior to today as part of a whole that will bring you to the successes that you will enjoy. And I believe that the information that we will share today will be monumental in helping you to make some big progress towards having the consistency and predictability that you're hoping for. So my goal today is to talk about one of the fastest and most reliable ways for you to be entering and exiting your positions at the right time. How many of you have trouble with your timing? Say I. How many of you find that the moment you get into a position, things find a way of just going against you, and the moment you get out of a position, things finally turn around? Say I in the chat. Let's see how many of you are struggling with this. Mohammed, trading is very hard, no help. I. We've got a lot of this. So if this is something that you are still struggling with, this workshop is for you. Now, there are thousands of ways that you could work on this. It's my conviction and my belief that the fastest, most reliable way for you to enter and exit your positions at the right time is by following this group of people that is sometimes referred to as the smart money. What is the smart money? Who is the smart money? Well, Ray Dalio at Bridgewater Associates has become the smart money. So let's take a moment and define who this is and what they are, and then we'll get into how we can follow them. So I want to pull up a slide deck from JP Morgan Chase's Investor Day. JP Morgan Chase is one of the world's largest banks. And obviously they've got a conglomerate of businesses. One of those businesses is investing in the equity markets. And I want to take you to their slide deck here where they review their results from their trading business. And we're going to focus on this right here. Take a look at this. This is a 5-year period of time that they are reviewing. During that 5-year period of time, now remember, there are on average 252 trading days per year. Notice that only in 2012 and 2015 did they report any days where they were a net loser on that day. We're talking about 9 days out of over 1,300 days, they are reporting that they have a positive return by the end of the day. We're talking about a 99.7% win rate. Huge, right? So big that it's almost scientific and predictable, their outcomes. Take a look at their average daily revenue, their average daily profit during that period of time. 69 million, 72 million, 67, 70, 80. Notice the fluctuation here. It's not as though from year to year, their average daily revenue is way up and way down and way up and then sideways. Okay. Not only is their winning percentage on par with almost being absolutely predictable, but their average daily profit over a 5-year period of time barely fluctuates and averages out to $69 million per day. So this is so consistent that it leads us to deduct that it's almost predictable. And I would say that it is predictable. This is who you are up against. You and I are up against these institutions. These institutions have more assets, more technological capability than you or I will ever be capable of getting our hands on, more than likely. Their technology is not being sold for a subscription. They are not teaching educations, and they are not hosting workshops like the one that we're doing right now. Yet these are the ones that consistently and predictably win in the market. Alternatively, you and I are consistently inconsistent. Okay. Brad says, by daily revenue, does that mean they're cashing out that much every day, or is that equity growth each day? That is their average daily profits by close of business in this period of time. So it is my belief, and it is my job today to help you to recognize that there's a big mountain in front of you if you expect to compete on a fair level with institutions like this. I believe that the fastest and most reliable way for you to operate in the financial markets is by following these folks, these large institutions that move the market. So that's what we're going to talk about today, and we're going to dig deep here and show you how to do this more realistically for you and I. By following this smart money is not getting to a point to where we're managing billions of assets, or having $69 million per day in revenue. Here's an email that I got from one of our retail group members. After following this process for about 18 months, he sent me this email and said, now my biggest problem is that I'm growing my account so quickly, I have to pay more tax if I want to convert this account into a Roth account to gain some tax benefit. He says, now that I'm all in with this investing technique, I'm currently generating an average of $50,000 per month among all my accounts. So that's my aim, is to help you to realize how much opportunity there is available to you, and that opportunity will quickly come to you as you start to follow the people who have already invented the wheel, who are moving the market, and stop buying into the next nicest trinket that somebody sends you in their email. So if knowing and understanding how to follow the smart money isn't beneficial enough to you to hang out with us in this masterclass today, for everybody that sticks around with us to the end, I will be giving you a tool that you need to have. This is what we call our analytics tool. Now, this tool allows us to analyze the performance of our portfolio and the experience we should be having in the markets by monitoring key metrics that every one of us should be monitoring, that most of us aren't. You see, when we open up our platform, most of us have access to that P&L number, right? Where we see what our profit and loss is. Sometimes it's red, sometimes it's green, and that's where we make our decisions from. However, on the institutional side, and I'm going to refer to that word a lot in our workshop today, institutions, or the smart money, they're doing things completely different than you and I. They're not monitoring their profit and loss to make decisions. They're monitoring their accuracy rate and their reward to risk ratio. How many of you know what your win rate is over the past 2 years? If you haven't been trading that long, that's okay. But for our more experienced folks, how many of you know your win rate? That is, how many times you're right compared to how many trades you make. If you've made 100 trades and you were right on 60 of them, that would be a 60% accuracy rate. How many of you know your win rate? Okay, so we've got some honesty here. Pablo says, when I was a futures trader, I was. For stocks, not so much. Mohammed says 30% win rate, 70% loss rate. Okay, member says, I don't know. Great, Glenn. That's awesome. I'm glad he's keeping track of it. So there's a lot of I don't know. I don't. We've got very few I do's. If you don't know what your accuracy rate is, what your win rate is, it's very difficult to know how much you should be risking on each position. How many of you have ever heard an educator or somebody tell you, don't risk more than what you're willing to lose? You guys ever heard that? Don't risk more than what you're willing to lose. Okay, Mohammed, yes. Brad, yes. We got lots of yeses. Do you believe that an institution like a JP Morgan is telling its traders, don't risk more than what you're willing to lose? Or do you believe that the direction of how much capital to risk is specific and based on systems they've created? You know the answer to that question. They are not approaching the market saying, oh, we're not going to risk more than what we're willing to lose. Okay. This analytics tool is going to help you to start beginning to assess how much you can be risking. Brad says, I expect it is very specific. So with this tool, again, I'm going to give this to everybody here in attendance here today. And I think that it was mentioned by Brad that his MetaTrader platform does keep track of that data. But with this tool, you're going to be able to input these two key metrics, your win rate and your reward to risk ratio. Somebody had mentioned that they've got a 30% win rate. That is to say that out of 100 trades, only 30 of them are going in their favor. If I asked you, how many of you think that is a good win rate, say aye, or say good. If you had a 30% accuracy rate, say aye. Is that a good one? Is that a good accuracy rate? How many of you think that is good? Oh, Brad, you're brilliant. Glenn, you're brilliant. Okay. Brad and Glenn say, can't tell without the reward to risk ratio. Mohammed says, or Glenn says, same thing, depends on depth of losses. Boz, great, yep. Pablo, yes. Member, yes. Okay. We don't know. In fact, there was a group of retail traders, they were called the Turtles. The Turtles are, by and large, the most successful retail group of traders we know of that have been documented. They were only right about 15% of the time. That means that out of 100 trades, they only won on about 15 of them. That's a low accuracy rate. And most of us would not be happy with that. However, they understood something that most of us don't because we don't have tools that allow us to know the relationship between your two key metrics, which is your win rate and your reward to risk ratio. What they had, they averaged, even though they were only right 15 times out of 100, when they were right, they were making about 30 times what they were losing when they were wrong. So that means that for every $1 they lost, they made $30 when they were right. Plug that reward to risk ratio in, and you can begin to see the relationship of how that accuracy rate, that win rate, is tied to that reward to risk ratio. We go from, if all we're doing is making $1.50 times 1.5 times what we're losing, with this win rate, it's not going to look so good. We're on a path of pretty well blowing up our account. If these are your metrics, you know that this is not sustainable. And there is no reason for you to be risking anything. However, if your reward to risk ratio is 30, this is going to be great for you. It's going to be choppy at times, and you're going to go through long periods of times of losing streaks. However, these metrics align with one another. So my gift to you for spending some time with me here today is giving you and putting this tool into your hands. Now, if all we can do is get our metrics aligned with a very conservative metric like a 70% accuracy rate and say a 1.50 reward to risk ratio. That means that 70% of the time we're making, say, $1,500 per trade. And 30% of the time we're losing $1,000. These are achievable metrics for you. Starting with a $25,000 portfolio, your job is simply to keep it up. Just keep these metrics aligned, and in due time, your portfolio, through the phenomena of compound interest, is going to grow into a very large portfolio. Now, the great thing about this tool is that it now starts to allow you to visualize what you can expect from your experience of keeping these metrics aligned. You're going to go through losing streaks. You're going to have drawdowns. Most of us, after a losing streak, we start looking for greener pastures. We start to buy into the next best thing that somebody emails us is the fix to all of our problems. But the reality is that your focus should be on metrics. You don't need lots of training and lots of systems. You need to be consistent with something that gives you predictable metrics that lead to a profitable experience. This tool will allow you to visualize what your experience will look like based on these key metrics. For example, if I have a 70% win rate and a 1.5 reward to risk ratio, I may have 5 trades in a row that lose for me. I may have a 15% drawdown, a 14% drawdown. However, if I maintain these metrics, and that's where my focus is, and my focus turns away from being happy when I'm making and being sad when I'm losing and having a bad weekend when I have a losing week, you just keep your metrics aligned, and this little $25,000 account will become a 7-figure account in due time. So I will be giving everybody here in attendance this tool, and it will be something that I think will be a great resource for you. How many of you can see how important measuring and seeing the relationship between these metrics allows you to just stick to a process that gives you these metrics? How many of you can see how much that changes your vision of where things are going? If all you see is, well, I'm down 14%, and you don't know that, wait, I'm maintaining these metrics and I know where it leads as long as I do that. If you don't see that, you're inclined to quit, give up, and move on to something else. Awesome, Boz, Trader Muhammad, great. We're going to get you this for free. And patience is definitely important, but having correct vision of where you're going and what your current outcomes are going to get you is going to help. From now on, anytime there's no problem in following somebody that is willing to share their expertise with you. But from now on, all you have to do is ask these 2 questions. Hey, send me your brokerage statement so that I can see what your win rate is over the past 2 years. Or, and also, I want to know what your average profit and your average loss is during that period of time as well. And then you're going to come over here and plug it into this tool. And as long as things line up the way they need to be, there's no problem with following somebody that has a system that leads to predictable outcomes. This tool will also allow you to silence a lot of the noise in this environment of people willing to share their expertise with you. You just ask them 2 questions, plug it into your tool, and it's going to give you a great visual picture of what they can do for you. All right, let me introduce myself, and we're going to jump head deep into our workshop today. My name is Nick Lovelace. I think that, let's see here, maybe my cam, can you guys see me okay? Good to see you here today. This is live. I'm not sure if it's being recorded or not, but I'll keep my face off of here. Thank you, Mohammed. You're very kind. But great, awesome. So this is me in the flesh. I'll keep the camera off right now. I'll come back on later on. But we've got 6 kids. My wife and I, young kids. It's fun being in the market because you really can. It gives you the liberty to really have a whole lot of freedom. So it's a lot of fun. My education, my experience. Some of the things I love to do, I love to fly fish. I love to fly. I started flying when I was 14 years old, got my pilot's license before I turned 18. And this is what 18-year-olds do when you get, when they let us fly as young as we did. Our frontal lobes aren't fully developed and we fly in riverbeds. Maybe not the smartest thing to do, but some great memories. I attended Brigham Young University, studied finance and stats, and since then had a stint at Goldman Sachs on their options desk, and right now I am the co-investment officer for a hedge fund called Alpha X Capital. We manage money for accredited investors, basically the ultra wealthy. This is me. We've got a great team over here with several statisticians from Google and PayPal, and we've built a great fund over there for our accredited investor friends. But inevitably, we come across and interact with a lot of people that aren't accredited, that don't have at least $1 million net worth. And yeah, go Cougs there, remember, especially this past week, Arizona. So we ended up building a retail group where we were able to pass along the systems that we've built for our hedge fund and allow retail self-directed investors access to an institutional quality system. And that's been really fun to be able to be a part of that group and see the success of retail self-directed people. So let's jump right into the topic of our workshop today, and that is, how do I get in and out of positions at the right time? We already established that the fastest, most reliable way for you to consistently achieve predictable success is to follow the folks that are achieving that predictable outcome. When you have a 99.7% win rate and you're averaging 69 million per day, this is predictable and it's scientific, and I want to follow them. I don't want to follow the guy that is teaching me how to trade. I want to follow this guy. So let's establish a basis for how we understand this. When I refer to getting in and out of positions at the right time, you and I, really, we have one big question, right? We want to know when something is going to hit a level and stop going higher, and when price is going to hit a level and stop going lower. There's all sorts of tools available to you and I to do this. And you know through experience that all of them are still causing you to struggle quite a bit at achieving predictable success. So this is kind of the basis that we are proceeding on. We want to know when these things are going to happen, right? When the shifts are going to happen and where they're going to happen. And number two, why they happen. We really don't care why. We just want to know when they're going to happen, right? Is that what we're all here for, is to know when those shifts are going to happen? Say aye if that's what you are here for, and that's one of your biggest problems, is knowing when those are going to happen. say I in the chat. We got a ton of them coming in. Okay. So this is obviously one of the biggest. This will resolve all your problems. You've got a small account. If you can figure out when these moves are going to happen, before they happen, you're going to have a big account. If you lack consistency, that problem's solved if you all of a sudden know when these things are going to happen. And that's what we're going to do today is I'm going to show you how to follow an institution like this, like JP Morgan. They're predictable. They're consistent. It's not guesswork for them. And there's a way that we can follow them. So let me just introduce to you this group of institutional investors a little bit more. The FINRA, which is the regulatory authority for our financial markets, they recognize two core groups of investors or traders. They categorize you and I into either non-professional or professional. And on their website, finra.org, they note that of non-professionals, these are what we call individual traders. Generally, their buying and selling activity has no major impact on the direction of individual stocks or in the market overall. So this is your starting point. You don't control very much, and that's a problem when you want consistency and predictability. Alternatively, those that are designated as professionals by the FINRA, these are what we refer to as institutional traders or the smart money. They include pension funds, hedge funds, banks, insurance companies, other large investors. They account for over 70% of all volume. And because of their dominance, their activity is what leads to big price moves in individual stocks and in the market overall. So again, the foundation from which we are beginning our workshop is that number one, you and I have got a problem with getting in and out of positions at the right time and being consistently profitable. Number two, there's a group of people, and it's not your teacher or educator, who is radically consistent and their outcomes are radically predictable. And number three, the best way for me to proceed, if I can do it, is by following these people. Last I looked, they're not offering subscriptions to their trade ideas. So we have to go about it another way. So how do we do this? Well, there's some ways that we don't do it. How many of you have heard of unusual options activity or dark pools? Okay. How many of you have heard of those things? Say I. Si, senor. Yes. Awesome. Okay. So a lot of us have heard of unusual auction activity or dark pools. This is in reference to attempting to identify where these big traders are doing their business. Let me show you why this is not something that is going to be reliable. There's all sorts of ways we can track what these big traders are doing. There's even websites totally dedicated to giving us insight into their activity. Fintel.io is a resource. You can come over here and see what is Bridgewater Associates doing. This $160 billion fund, what are they doing? Well, we can come over here and see that they reported last quarter to have increased their shares in Walmart by 45%. Boy, that's good information, right? So we could make the assumption that, boy, these people, this large hedge fund, they're the most profitable, most successful fund in the world. They're bullish on Walmart, so maybe I should be as well. And you may be right, But the problem is, in order to make this assumption, you have to make a big assumption, and that is that Bridgewater Associates is using their position in Walmart as a directional bet in their portfolio and not a hedge for their portfolio. Notice that they only report approximately $15.5 billion in positions in equities. Well, that's leaving out a whole lot of the $160 billion they have under management. Where's the rest of it? What part does Walmart play in their overall view of the market? Are they bullish on Walmart, or is Walmart simply a hedge for the other larger part of their assets that isn't being reported where that's at? Are they short the dollar, or are they long the yen? We don't know. Those things aren't being reported in here. Another way that you can do this following institutions is by looking what we call at unusual sized activity, unusual options activity, or unusual positions, block trades, things like that. So as we look at orders that are flowing through here, now this is live today, we see that somebody just bought 150 contracts of call options that expire in November of this year. They spent $11.39 per contract. We also see that they bought the same amount, 2,703 contracts of 140 call options in September, this month, the 17th. This is big, big money, right? I mean, let's just look at the very first position. With 2,703 contracts, these are options, and so we multiply those by 100 to see the share equivalent. That's equivalent of 270,300 shares. Times that by $11.39. And whoever this is just spent almost $3.1 million buying options on Apple. These are call options. And so when we buy call options, the assumption is, or the benefit to the person buying those calls, is if the stock goes higher. So we could look at this piece of data and we could say, well, whoever this is probably the smart money, right? And boy, they bought calls on Apple and they spent a lot of money on them. They must be bullish on Apple. And they may be bullish on Apple. But what if they sold these call options 4 months ago and are buying to close them? They sold to open them, meaning they had short calls. And today they bought to close them, and you think they're buying to open. Or what if they are short Apple and these long calls are just a hedge? It may be true that they're buying these because they're really, really, really bullish on Apple. But in order to follow this information, you have to make assumptions that will make you, you know what an assumption makes out of you and I? You have to make assumptions that you can't make. So we cannot directly follow these large institutions that are predictably, scientifically accurate and successful by direct observation. There's no way for you to do it. Even if they come on CNBC and say, I am the person that bought the 2,300 contracts of Apple and I couldn't be more bullish on Apple, you don't know what their real intentions are. They're smart for a reason. Everything they do is calculated. So how do we follow them? We follow them by indirect observation. Kind of like the way that we observe the largest, most powerful forces in our observable universe, black holes. According to NASA, the way that astronomers are able to detect the most powerful object in our universe, black holes, is by detecting their effects on nearby stars and gases. And I think that it's a really neat parallel lesson that the largest observable force, or the largest force in our universe, black holes, light can't even escape them. The way that we observe them is by watching for their effects on other things around them. It's a neat parallel because that's the same way that we are able to successfully and accurately follow the smart money, is via indirect observation. You see, because of their size, these institutional traders leave an impact on what I'm going to refer to as the auction of the market. See, the market is simply an auction. Price goes up and down and up and down and up and down. I'm referring to the auction as this up and down gyration in price. Institutions impact that up and down gyration in a way that can be detected. So I want to show this to you, the three effects that institutions have on the auction of the market, the up and down of the market, are these three effects. The first one is price clusters. The second one are chasming or gaps. And the third one is referred to as vertical imbalances. Now, you may have heard of these referred to as different things. This could be referred to as consolidation. This could be referred to as a gap. And most of us refer to this price pattern as a vertical imbalance. Now, it should be noted that a gap can happen down and a vertical imbalance can also happen lower. So I want to ask you, of these three profiles, which of these three do you believe is where the big institutions are doing most of their business? Remember, according to the FINRA, their activity makes up over 70% of all the volume. So as we consider the three price profiles in the markets, which of these three profiles do you believe is where most of their transactions and their buying and selling occur? A, price clusters, B, price chasms, or C, vertical imbalances? Okay, Brad says A. Oh, Doug. Doug is my friend. I know Doug, and he knows. Okay, we've got lots of B's and C's. We've got lots of C's. Some A's. Trader says A. Trader says A. Muhammad says A or C. I don't know. Pick one. Lots of B's. Okay, I'm not going to say what Doug said because he knows. Okay, the answer is A. Now, I want to prove this to you, first of all, in theory, and second of all, in principle, and show you that this is actually true. So consider you have an institution yourself. You operate a fund, and you have an equity, the most famous non-equity in the market, XYZ. And XYZ trades on average 5 million shares per day. You, however, own 10 million shares of XYZ. Okay? If you wanted to sell your XYZ stock, you have to have buyers on the other side that take it from you. The market is simply an auction where there is a certain number of buyers and a certain number of sellers. If you came to your platform at the open and submitted an order to sell your 10 million shares of XYZ at market, and let's just say, for example, right at the open, the market is opening at $100. You bought these shares all the way down at 40. You've got a very solid profit in your 10 million shares and you want to sell them. Remember, XYZ stock is averaging 5 million shares or 5 million in volume per day. If you came to the market and submitted this order to sell your 10 million shares, there are going to be a certain number of buyers looking to buy at or around 100. But if the average volume per day is 5 million, there's not going to be 10 million worth of buyers to buy at 100. So what will happen once you submit this order is the auction of the market, which is simply an algorithm. It's a program that is searching for where business can be completed and done. If you submitted this order on the market, what would happen is maybe 1,000 of your 10 million shares get sold at 100 because there was somebody that wanted to buy 1,000 shares at 100. And now what you've done is you have flooded the market with 9,909,000 shares available for sale, and there's not enough people willing to buy right now. So what the auction will do, the program that officiates this balancing of buy and sell orders, is it will then begin to hunt for where there are buyers. And what it will do is it will rapidly drop through various prices. We will go down to 90 and then to 85 and then to 80. And all along the way, a portion of your 10 million shares are being sold off to buyers that wanted to buy at these levels. And then it will go to 75 and 70 until all 10 million of your shares are dumped, and maybe it gets all the way down to 50 before it is able to find enough buyers to take your 10 million share sell order. And the moment that your 10 million share sell order gets filled, the market will come right back up. These are what we refer to as flash crashes. One of the most widely known flash crashes was back in the mid 2000s in the overall market, right? How many of you all remember the flash crash that happened back in 2011? Or is it, 2011? How many of you guys remember that? Okay, or May 2010, I apologize. Okay. Yep, thank you, Brad. Yeah, a lot of you remember that happening. You've heard of this referred to as a fat finger trade. Institutions don't want to do this. Okay, this is called uncontrolled exits or entries. obviously, if you're an institution, you don't want to crash price all the way down back to about where you got in and have it go right back up. Same thing with getting in. If you came in and wanted to buy 10 million shares, there's got to be enough shares available to sell to you. Well, if there's only 5 million per day, there's not going to be 10 million available to sell at the current price. So if you came in and issued an order to buy 10 million shares at the market, you're going to get filled on a portion of those at the current price, and then the auction is going to race higher, finding sellers. It's going to stop out shorts. It's going to stop out people that had orders to sell their stock at a certain target, and it will continue to rapidly go higher until this big buy transaction is filled, and then it will come right back down. They don't want this to happen. This is unorderly. Institutions are orderly. They want orderly entries and orderly exits. And so the truth is that the majority of their volume, the majority of their business is done in this kind of a profile, this price profile. A is where they most of the time do their business. Now, again, occasionally they'll do their business here, okay? But in that case, they're flash moves and they come right back. Flash moves, they come right back. They don't want that. That's not to their advantage, all right? So that's the theory behind it. Let me prove to you that it's actually true. So here we're looking at Facebook. Facebook closed the day here and opened the day over here. The dark gray is the overnight activity. The light gray is the day-to-day. We're looking at an intraday chart. Facebook reported stellar earnings and opened up 14% the next day. This is a big move. We have a big vertical move here. And again, the question is, where do institutions do business? Do they do it once they reported positive earnings? They went in and bought a lot of stock, and that's what caused the stock go up? Again, not typically so. We can check it out by overlaying what's called a volume profile on top of this chart. Most of you have access to this tool at any major brokerage with charting software. A volume profile takes volume and overlays it at where that volume occurred at what price level. And we see these horizontal nodes. Notice we've got these big horizontal nodes during the market open, and then when this big move happened, look at how thin the volume got. I mean, there's just not a lot of volume. Remember, institutions do 70% or more of all the volume. So we're looking for where they do business. Well, there's a lot of business here, not so much here. So did they cause the big move? Nope, they didn't. Not a lot of volume. Institutions were not doing that. But notice what happened. It started clustering. And look at the volume, what it did. We start to see the presence of more volume. And then it went vertical. And look at what happened to the volume. It dropped off. And then it went and clustered. And look at the volume node. We see larger amounts of volume coming in. So up to this point, we've established that the best way for you and I to realize consistent, predictable success is by following these institutional traders or participants. It's the most reliable way for us to proceed. They are radically consistent, and obviously their outcomes are predictable, scientific. That's the best way for us to participate. They aren't selling access to their trade ideas. They aren't giving access to their algorithms. And so the next best way is to try and observe what they're doing. We can't directly do it. We have to do it via indirect observation. And the way that we do that is by knowing where they do their business. Where's all this volume? If they make up most of the volume, where's most of the volume happening at? You will find that consistently, almost all the volume occurs in these clustering profiles. So we've just discovered the first key to following institutions is they do their business in these profiles. Well, if their results are predictable, like JP Morgan's Investor Day suggests that they are, then these clusters that occur on our chart must be predictable. And that's what we're going to spend the rest of our time here together in this masterclass, is showing you how predictable they really are. To do this, I could simply pull up my own charts and show you, but that wouldn't give you very much. I want to show you using stocks and indexes or ETFs that you're interested in. So go ahead, find the question area or the comment area, and go ahead and put in a stock that you're interested in, and I would like to show you how to identify where institutions will do business on stocks that you're interested in. I'm going to grab a quick drink of water, and I expect to have a list of stocks when I come back. Okay, this is great. We've got a lot coming in here. So I want to take a snapshot just so you see these are coming from you all. Okay, I'm going to take a snapshot of the question panel. Can you guys see the question panel? Can you guys see other people's comments? If you can, I don't need to go through this effort of making sure that you can see that I'm taking these names from you all. Okay, so Pablo says no. All right, so we've got a lot here. We've got GDXJ, CIM, Target, Roro, Pfizer, GDX, EWZ, Emerging Markets, SPY, Ford, ARC, XLI, Amazon, XLE, Apple, Tesla, Ford, LGO, DDD, GBTC, Cybin, and Walmart. And I know what Raymond's thinking. He's thinking, Bridgewater, they just got into Walmart, increased their size 45%. I want a Walmart. All right. So, trader, we established that following the smart money is the best way for you to get in and out of things at the right time. So, how do you trade gold? Learn how to identify where the smart money is going to do business and do it with them there. So, let's go ahead and do this. So we have to have an asset where institutions are doing business in that asset in a big way, okay? And so we want to use assets that have a large amount of institutional participation. So let's start off with that one. Let's start off with GDX, okay? Now we could do GDX, GDXJ, the junior minor, it doesn't really matter. So I will do GDX, let's see here, GDX and GDXJ. Let's go ahead and go with GDXJ, the junior minor, okay? It's a $42 equity. Taking a look at this chart, we're looking at a 20-year chart. Now, first of all, we want to see and make sure that we have sufficient volume in this product that allows us to know that, institutions do business in this thing. Anything less than 2 million in volume per day, there's probably not a lot of institutional participation. Well, that's the premise that we're proceeding, is that that's the best way for us to succeed, is following institutions. And as you can see, the average daily volume is probably close to about 5 million per day on this equity. So this is great. this is a good starting point for us. We can work with this one. So here's what we're going to do. We're going to go out to a 20-year chart. And notice back here in this period of 2009 and all the way through, I would say 2013, there's not a lot of volume here. Now on a monthly basis there is, right? Because this is a monthly chart that we're looking at right now. One candle is the equivalent of 1 month of activity. The entire month of March of 2012 only had about 16 million in volume. So if we divide that by your average number of days in the market in any given month, that's giving us approximately 825 million shares traded per day. So not a lot of institutional activity back in that time period. So I'm going to avoid this time period in creating what you're going to learn. We call it the matrix. Because we don't have a lot of institutional participation back here, I'm going to draw the conclusion that most of this activity was not done by institutions, and they're the ones that their results are predictable, and I want to build a framework where I can track their processes. Now, as we look at this chart, a lot of us, depending on the training that you've received, we would maybe do something like this. We'd connect that, and we would come over here and connect this, and we would say that, oh, I see, we've got an expanding wedge pattern. How many of you have ever heard of the expanding wedge pattern? Say I. Okay, that is one common thing that we would do. Okay, a lot of you say, yeah, I know what that is. One of the other things we would do is we'd come over here and we'd say, oh, you know, I've got a bull flag pattern, right? I've got a bull flag pattern, okay? Right now I've got my flag right here and my flag pole is right here, okay? So we've got a bull flag pattern. We've had lots of people want to teach us about patterns, okay? But remember, institutions are the ones that make all the money, and those patterns, at least so far, are still causing you to be consistently inconsistent. And certainly, JP Morgan is not coming to their charts and overlaying patterns and recognizing flags or expanding wedges, and that's how they're achieving their almost flawless consistency. There's something more predictable, something that we don't have to constantly be drawing new lines on. So I'm going to erase these, and we are going to go into the assumption that institutions do business when price is clustering. So we're going to go to a 15-year chart, and we're going to focus in on this area right here to build the framework for what we're going to call our institutional auction zone matrix. So institutions do most of their business in clusters when price is clustering. And so that's the first thing that we're going to attempt to identify is where do clustering profiles occur? Here's some clustering, okay? Here's some clustering. Now we're now looking at a weekly chart. Each one of these candles represents a week. Here's some clustering. Here's some clustering. All right, we've got a lot of clustering in this chart, right? We're not looking necessarily for these, you know, perfect V bottoms where there's a dead low here and there's no clustering, right? We're looking for clustering areas because remember, their outcomes are predictable, so it must be that where they do business must be predictable, and we know where they do business is in clusters. So instead of connecting tops and bottoms and drawing trend lines or patterns between them, we're going to attempt to connect where the clusters connect to one another. So here's how we're going to do this. Let's start on the left-hand side of your chart. We're in 2014. I'm creating this away from recent activity so that I keep my analysis as objective as possible. You and I have a tendency of bending lines to explain why something just happened and to give justification for, oh, it just came into support or it just came into resistance, I'm going to get in. I'm going to create this framework for where institutions do business away from anything recent. And if I do this correctly, 95% of every top and bottom will come within and happen within this framework that we're going to create. So over here on the left in 2014, we go 1, 2, 3, 4, 5, 6 weeks of price clustering. So I'm going to use a trend line tool, and I'm going to go to the top end of that clustering area, and I'm going to attempt to connect that to other clustering areas that happen in this viewpoint that we currently have. So I'm going to connect it right there, and I'll extend that to the right. So this would mean that this cluster is connected to this cluster, and those two are connected to the clustering activity over here. Most of us would do something like this. We would go and connect it like this, and it never ends up making it all the way up to this one, but comes up to here and fails, and we don't ever have the opportunity to get in, and we miss things, okay? We're not drawing trend lines connecting ultimate peaks and troughs. We're identifying these clustering zones and where the majority of business is being done by institutions. So let me extend that to the left. We'll extend that to the left. This is the initial area where we're saying that if price rises up into this area, institutions are going to do business here, and price should be expected to, at a minimum, stall in this area, and this should act as resistance. Okay? If we break above this area, when price comes down to it, this is an institutional auction zone, meaning that price should at least stall in this area, and institutions will likely do business here before either it continues lower or reverses higher. So this is the first area. Now from here on out, every auction zone, institutional zone that we create is going to be the same height as this first one. It's also going to follow the exact same curvature that we have, slope, if you will. So I'm just going to duplicate this line and bring it down to an area where we have other, some other areas where price tends to cluster. And so I'm going to bring that down to about right in here, okay? I want to get this here, that low there. Notice we get, this is clustering here. We've got clustering here. We get clustering here, and then it goes vertical, okay? We come down into here, we stop right there. We get extensive amounts of clustering over here. And so that's where I'm going to bring it into. So we're going to bring down our little measurement tool of how large our zones should be. We're just going to duplicate this line and bring this one up to the top of this box here. All right. So again, this is my initial framework for operating in GDX. And so although I've got quite a bit of experience doing this, and we've got software that does this for us over at the fund, you don't need any fancy software. And if I do this right, 95% of all of our tops and bottoms will fall within this framework. Okay, so now what we're going to do is we're going to measure the distance between the top of our top zone and the bottom of our bottom zone. And from now on, to complete this framework, we are going to simply build out these lines all the way up this chart with the exact same distance between our first two and the exact same width and height of those ones as well. And we don't have to go very far because this is trading at $42 right now. So this one will be relatively quick. But this is where most of my major peaks and troughs will fall within this framework. Okay, so let's go back to our monthly chart and see. Okay, so again, we performed this analysis by looking at this area right here. All right, so as we see, we've got later on, we come into this here. We don't have a lot of data to go off of on this one, and so it doesn't give us a great feel for whether or not we got this right. But notice price traded over here well up above how high we've built this framework. Let's keep on adding to this and see if the previous all-time high did not just so happen to come into exactly this little framework that we've got built. I'm going to do as many of these examples today as we can get through. And by the end of this, I think you will see how predictable using this framework really is. All right, so we're just building out this matrix that will help us to know where price should find resistance if we're coming from below up into, and where price should find support if we're coming from above and dropping into a zone. All right, oops, didn't mean to expand that. Let's pull that up here, and we've got this. Okay, so as we go out, and this is applicable on all time frames, folks. So we perform this analysis by simply looking at this area. Notice that when this product was released to the market, look at where the first trough, where it came into, right into our auction zone. And then it went vertical, and where did it spend the bulk of the next 1, 2, 3, 4 months before proceeding? Right in our auction zone. And then it went vertical again, right in our auction zone. Again, this is just a first stab. So there's some slight little shifts I would make in the distance between each of these, but look at the precision of your trough here. Look at where your reversal came here. Look at where your reversal came here. Look at your reversal where it came there. Look at the support here on the monthly chart. Where did it bounce at? Right at my zone. It clustered there, it bounced back up to that zone. Where did it stop on the next one? Precisely at our zone. Where did it bounce to? Right at our zone. Okay, this one dropped, not quite to our zone, but like I said, this is just the first look, and we can refine this a little bit further, but basically right at our zone. Where did it go up and go vertical at? Right to our zone in here. Where did it go down to and spend the next 2.5 months? Right at our zone. Where did it drop to? Right at our zone, and it clustered there for 1, 2, 3, 4, 5, 6 months. Okay, where did it find resistance? Zone, zone, auction zone. Okay, auction zone. Where did it find resistance from the low of 220? Auction zone. All right. So I would refine this just a little bit more, but look at how many peaks and troughs came exactly in our auction zone area. Close to 90 to 95% of them. Now, again, we want to refine this just a little bit more, but you can see I focused in on just this area, and it just so happened to be previous exact peaks and troughs. Mohammed says 95% came in. Wow, he says I'm shocked. All right, let's do one and let's refine it further. So let me go back to my list here of stocks that you guys want to look at. So we just did GDXJ. Let's take a look at CIM. I've not done that one. Let's go take a look at CIM. Okay. CIM, again, we are looking for something that has a significant amount of institutional participation. So one of the best ways for us to do that is take a look, see what's the average volume on this. Okay. So obviously we've got, some volume coming in here, but now, we're barely clearing 1 million a day. Not a lot of institutional participation. So not one that we would be inclined to do this on. So CIM is not one that we'd want to do this one on. Okay. So let's go to our next one. Let's go and take a look at Target. Now we know that Target has a large amount of institutional participation. We know that, right? It's a big mega cap equity. Lots of volume on this one. Okay, so we're going to do the same thing. It appears as though, and what most of us would do is we would come over here and we would draw a trend line like this. Oh yeah, that, when it comes down to that, it's going to find support. That's what it's been doing the past 2 years, right? Okay, or we'd come over and we'd do this number, okay? Or we'd come over and do this number here, okay? We would have things going up, down, sideways, right? All sorts of ways. Once you create this matrix, remember, institutions aren't out there doing what you're doing. They're not following the indicators you're following. Everything that you and I typically do and is being taught to us is the antithesis of what they're doing. So you can pretty well abandon it. Once you create this zone on Target or any other equity, you don't ever have to change it if you've done it accurately. So to do this, we're going to go back to this same time period we're looking at 2006, 2007 through, on our chart, we've got through 2013. And this is where we're going to focus on creating our matrix. If I do this right, the high that we just came into a couple of months ago will be exactly into an auction zone. So let's do it. So here's a cluster. Here's a nice little cluster down here for 1, 2, 3, 4, 5, 6 months, 7, 8, 9, 10 months. Clusters in here. There's a nice extended cluster right there. Okay, we've got some nice clustering in here. We've got some nice clustering in here. How are these things connected? Okay, again, if you're new at this, you could go in and make the assumption they're connected this way. Oh, we got a cluster here, cluster there. You could do that. Never, ever, ever are you ever going to be drawing descending lines. That's not how the algorithm that institutions largely operate under works. It just doesn't work that way. Even if for years and years, like Ford, even if Ford is going lower, you don't connect them going lower. That's not how it's auctioning. And I'll do Ford next here for you. Okay, you don't do that. All right, so how do we do it? Let's go back in here and let's get our trend line tool and let's attempt to connect where these clusters are happening at. So the first one that I'm going to do is going to be right in here. Okay, I'm going to go from that low in 2007, and we're just going to go across over here and be right about here. Okay, notice as we rose up in 2009, We came into this area, and 1, 2, 3, 4, 5, 6 months, we just kind of hung out right there. So that's going to be my first line that I draw in an attempt to identify my first clustering area, my first auction zone. All right, that's going to be my first one. Okay, so that's our first one, and we know that every one after this, and I will make sure this one is very, very precise, and we'll refine this one to the point of you'll never need to change it. I will give you this chart, and you can use this from here on out to guide you on trading targets. So this should be the height of each one of our zones. Let's duplicate one of these lines and pull it down to over here. Now, the difficulty with this is we don't have any other clustering areas within our field of view to reference to this cluster, okay? But we're just going to go under the assumption that this is how it is working, because we do clearly see, 6, 7 months of clustering down there. It is worth noting that the clustering area is here. We're just wanting to know the kind of the outer edges of where that clustering area should be. And that's where, if price is dropping down into that, that's about where we should find some support. We want to know where the outer edges of clustering is up top here. That's where it should find resistance. All right, so let's do this thing. So let's measure the distance between these. Pablo says, could you fine tune clusters by using volume profiles? You could, but you don't need to. Clusters are going to have all the volume that you need, and you don't need to verify it with the volume profile, although you could. Mohammed says, with drawing like that, I would be no good, would need help to set up at a later time. No, not a problem there, Mohammed. We're all starting at various points. So, all right. So now let's build out this matrix and this framework. Currently, Target is trading at $242. Within our field of view, this is $70 over here. And let's just build this out without looking to the right to see how it's working. And let's just see if our most recent all-time high in Target just so happened to fall right in this matrix. Let's see. Okay, so this is a mathematical matrix. The distance between them is constant because we know that institutions are constant. They aren't coming out and doing all these shifts in the way they operate and going from education to education and tool and widget to widget. They're algorithmic. We know they do most of their business in these clusters, and therefore the clusters should be connected in some way. And that's our work to do, is to identify accurately how they're connected and then use that as our framework for doing business ourselves. Any questions at this point? While I build this matrix out, I want to go up at least to about the 300 level. Now this is an ascending line, and we're looking at 2013 over here, so I don't have to go up too far past that. But all right, let me know if you're following along with me so far. Let me know that you're with me, and that at least on GDXJ, you saw a hint of how predictable this is. We're gonna, prove without a reasonable doubt that this is the best thing for you to be doing as we go through multiple examples. All right, Boz, all good. Traders with me. Mohammed, great. Yeah, so Glenn says, how about an example using an intraday chart? Such a great question, and I will gladly do that. So Glenn noticed that we're on a monthly long-term chart. And so this is a fractal technique, meaning that it is applicable on all time frames. However, shorter term time frames are always working towards a longer term time frame auction. And so it's important that you start your analysis on this big picture and work inwards from there. But I will show you on a short-term intraday time frame how this works as well. Mohammed says, a genius technique for long-term. It's a genius technique for any term. You will become a genius when you start simply following the smart money genius players. They're the ones that you should be following, and they participate on all time frames, and this same technique will work for shorter term time frames, but you can't start with a short term and have a great picture of where the short term is working towards. All right, I think we're getting close to completing. We've got, within our field of view here, we've got these lines going all the way up to about 280. I think this will about do it for target. So let's zoom out here and see what we've got. Holy smokes. All right. So just so you don't forget, our field of view was here to here. That was our field of view when creating this matrix. Let's just go through and highlight where our major peaks and troughs occurred, and were they in this auction zone framework. I apologize. We had all the way out to the end of 2013, right there. Okay. Look at our peak right here, right in our auction zone. Okay. Again, we have evidence here of clustering. So again, we want to refine this just a little bit, but let's just see how it's working so far. So we go vertical up into here, and this is something that we've not looked at yet, but you don't have to cluster right in. You can cluster on top of or right on the bottom of. And so we go vertical, where we've got higher high, higher low, higher high, higher low, higher high, higher low, lower low, higher high, clustering right here. Where's it clustering? Right on the top of our auction zone. Okay, it goes up a little bit further, comes back down, and where does it stop? Right in our auction zone. Goes away. There's going to be a mid zone in here that we can outline as well. Comes back down. Where does it cluster at? Right in our zone. Drops. 2017. Where does it find support? Right in our auction zone. Vertical, vertical, vertical. Clusters now for 1, 2, 3, 4, 5, 6 months. Right on our auction zone. Okay, right in our auction zone. Let's take a look at recent activity. Okay, vertical right into our auction zone. We want to refine this just a little bit. Okay, look at the support right in our auction zone. Verticaled up, it stopped for 1 month here, went to a mid zone. Okay, if we come in and look at that, there would be quite a bit of activity here, quite a bit of activity here. Vertical up, where did it stop? 1, 2, 3 months right in our auction zone. Vertical up, where did it stop? 1, 2, 3 months right in our auction zone. There's a tail right there. Where did it go to? Right in our auction zone. Where did we come back down to? Right in our auction zone. Vertical, 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 vertical. Where was the most recent peak? Right in our auction zone. Okay, where are we at right now? Right in an auction zone. How about before our field of view where we created this? Look at 2003, right in our auction zone. Where did it go up to and spent the next 8 months? Right in our auction zone. broke above that. Where did it find support? Right in our auction zone. Where did it find support? Right in our auction zone. Do you see how radically predictable this framework is at showing where the supports and resistance are? Now, you may see that this wasn't resistance, and that one wasn't resistance, right? And you may also see that well, this right here wasn't long-term support, it was this one. That's where your work comes in. You and I have no way of knowing whether or not one of these zones is going to be resistance or support. So as we rise up into here, you're not going in here and shorting the stock like it's going to zero. You are using intelligent strategies that take advantage of what price should do when it approaches a zone. When it rises up into a zone, we should at least cluster there for at least a several week period of time. Using options, I can place a strategy that isn't saying it's going back down to zero, but does say, I think it at least stays below this area for the next 2 weeks. Or I think that at least it stays above this area for the next 2 weeks. Now, breakout positions where we can buy calls or buy stock or short stock or buy puts, you can do those in this framework as well. But it's not done by picking, when we rise up into here, that's going to be resistance, it's going to go right down, it's going to come all the way down to here. We don't know that. Okay, and so strategy selection is important. So let me go into, because it looks as though we totally disregard this area and totally disregard this area on the way up. Let's go see if that's the truth. Let's go into a 5-year daily chart. And it looked like we completely ignored this zone on the way up, but that's not true. Look at that right there. Close enough to our zone that, again, we need to refine these just a little bit, but came right out of our zone, came down, that's right out of our zone. It went up, moved above this one, okay, and again, where did price stall for the next 1, 2, 3, 4, 5, 6 days? Right in our zone right here. Okay, it went up, came right down, tested the top of our zone right there, right into our zone for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, like 21 days right here. Came down, okay. So it did not just altogether ignore this zone or ignore this one. On the monthly chart, it appears as though it did, but it did not. It did not. So again, we could maybe refine this one just a little bit further, but this is pretty close to how you would want to have your auction zones on target. And I want to do as many of these as we can. I want to do something else like ARK. ARK is a new up-and-coming equity that is largely in new technologies. And that will be a fun one to look at because it's not been an available asset to us for a little while. And that will be a good way to show you how to do something on something with not as much time. All right, so insane, right? I mean, just this is not happenstance. Okay, now there's a whole nother layer to this in how you take advantage of it. But as price comes into these zones below, you assume that institutions are going to accumulate. With options, we can get into positions that say, hey, I don't know if it's going all the way back up, but it's at least going to hold this area for a couple of weeks. And so there's strategies that we can take advantage of that say, hey, I don't think it goes below here for the next couple of weeks. Okay, there's strategies that we can use to take advantage of if it's getting ready to break out, right? Okay, there's breakout strategies where we get directional. We buy the stock, we buy calls, or we buy puts or short stock. But that is the next layer of this, is interpreting and understanding how to function using this auction zones methodology. The bottom line is, can you see how radically predictable this is? Can you see how radically predictable this is? Okay, so I'm going to go ahead and share this chart, and let's get into one more here, and then I'll show you intraday and we'll be done. And I think that'll be some really good examples for you to chew on for the next couple of days. Okay, so I think somebody had brought up ARK, investments. We also have Pfizer in here. That's a good one. We've got ARK. I think ARK would be a fun one because it's kind of a growth equity. And you know, there's quite a bit of opportunity in these things. So let's go take a look at the chart. As we look at a 20-year chart, you know, there's really not a lot of data here, right? Not a lot of data in here. So let's constrict this to a 5-year chart, and we are going to focus in on this area right in here to build out our matrix. Let's do this again. All right, so we've got a lot of clustering here, some nice clustering here, nice clustering there. Okay, so we're going to come in on the peak of that tail over here in June of 2018. We're going to just bring that sucker across right up into other tails. I'm hitting the tail here in December, and that's going to be kind of my first little zone there. I will bring that up just a smudge to that overall peak on that one, and then we're going to duplicate this, bring this down, and this is going to serve as the framework for the width of each of our zones. And then I will show you an intraday one per Glenn's request. Glenn, give me a chart. So that's the one that we're doing next, an intraday chart. Give me a ticker symbol that you want to look at intraday for day trading stuff. Netflix, great, we'll do that one. All right, so let's duplicate this and pull this down to other clustering areas. All right, so clearly we've got, you know, a big bottom here, but it's kind of reversed, right? This is a V bottom. Remember, we're looking for clusters. That's where the most amount of business is done. V bottoms are not where most amount of business is done. A V bottom typically means that you extended past auction zones, and auction is trying to get rapidly back up to where business actually wants to get done. So I'm actually going to pull this up to these 3 or 4 tails here. We've got a tail, but other than that, we've got clustering in here. We've got clustering in here. Okay, we've got 4 weeks of clustering there. We've got clustering here. We've got clustering here. Okay, so that's kind of my purpose in doing that. So let's bring this down just a little bit more here. And I want to get the lower end of this cluster here. And this is going to serve as our framework for our auction zones. Okay, here we go. Now let's measure this. And the distance between each one of these zones will be constant from here on out. And if we do this right, price will suspiciously either reverse at these areas or at least pause temporarily, precisely at these areas. Let's build this out. Now this thing's trading at $124. We're currently sitting at a $65 equity. in our field of vision where we created this framework. Let's go see if this proves to be accurate. All right, let's keep going here. I'm not sure, Boz, if a recording is available or not. I'm not sure. This is being hosted by Investor Expos today. So I don't have any control of that, but I'm sure if there is, you will all get it. Yeah, sure. Yeah, definitely email me. And if we have one, then I'll give it to you. Otherwise, I can give you a resource where you can go and learn more about this too. All right, let's do this a little bit more. This thing's trading at $124 right now. We're getting close to that, but I know this thing peaked out close to 200, just knowing ARC. So we'll go a little bit past that and see how this thing is going at that point. The neat part about this is it removes the subjectivity, and if you do it right, which I'm going pretty fast, and on all of these I would refine them just a little bit. But once you set these, because institutions aren't changing what they're doing because they have no need to, nobody's really catching on to this. You don't need to change this ever again. And if you understand how to use the right strategies when price comes into one of your zones, you will do very, very well. And your results will be predictable. All right, let's do one more of these and we'll see how this is going. Yeah, you bet, trader. Definitely can give you some reference points to go and learn more about this. All right, so let's see here. Okay, so our field of vision when we created this framework was here. Okay, so we came off vertical, it paused right in our zone here. Came up, paused for 2 weeks right in our zone. Came up, 1, 2, 3, 4, 5, 6 weeks right at our zone. Right up into our zone here, right back down to our zone here. Right up into our zone here, right back down to our zone here. Okay, right back up to our zone, and for 3 weeks it clustered there, came up to here, spent 2.5 weeks here, a week and a half here, right on our zone there, came back down, zone, touch, and that was a little wave lower. Right into our zone vertical for 2 weeks, right there, okay, and then chasmed up to that one, close to that one, and again, close enough to where I would make slight adjustments, but it would be adjusting the whole framework, and we don't have time to do that on every one of these here today. But I just want you to see, look at where, again, right on our zone, right into our zone, right into our zone, right into our zone, right into our zone of support, right into our zone of resistance, right into our zone of support, right into our zone for the past 2 weeks. You see that? We created this matrix by looking at how the clusters were connected in that area, and then just built out that same framework all the way up, and almost without exception, all of your peaks and troughs are coming within this framework. Okay, trader says, can this be used to zones to trade spreads? Yes, that's most of what you should be doing, is saying, wait, when we come up to this one, I don't know if it's going to keep going higher or if it's going to reverse and go down to this one way down here, but I do know it's going to take a little bit of pause and cluster. So using options provide that dynamicism that allows you to take advantage of something just pausing in an area. And there are other ways to know that this thing is going to be going directionally, okay? You know, that we could spend hours and hours and hours together understanding how to operate within this framework. My point is that things aren't as random as what you may think that they are. Price goes to and finds support or resistance right exactly within this framework that we have outlined. Okay? It's not random, it's algorithmic. We know that by looking at JP Morgan's results, and it can be that way for you. All right, let's do one more intraday for our friend Glenn, and that will be good. And we'll end on that note and wrap up our masterclass here today. So, taking a look at Netflix, I've done this one. You know, most of these ticker symbols we've outlined. We've got all the auction zones for them already done. But because I'm going to focus on the short-term intraday, let me first show you what the long-term chart, where those zones are at for Netflix. Okay, so I'm not going to build out this framework live in front of you. The longer term, we're going to build out the shorter term framework in front of you. So here is Netflix. I had to pull up that chart. Okay. Notice, again, almost without exception, every peak and trough is right within your auction zones. These are mathematical. There's no difference in distance between each one of them, but this is exactly where, over the past decade, all of your support and resistance has fallen within this framework. So the short term is working towards those longer term frameworks. So as we look at the short term, we're looking at clustering areas that are outside of that long term. So I've got the long term here. So anything that's clustering in the long term, we're not going to draw lines connecting those right now, because those are connected to that long-term auction. Mohammed says, does this work on all assets? It does for those where there's a significant amount of institutional participation and the asset is not so large that we don't see, you know, institutional impact on price. Currencies are such a large underlying instrument that even institutions, their activity does not impact the auction very much. So you need to get away from caring about what asset you use to just getting in line with and trading with institutions. That's what you should be doing. All right, so let's go over here and take a look at Netflix. So we've got a nice little clustering area over here. So we're looking at an intraday framework. Let me get rid of. Actually, I won't get rid of the long term. We're just we're gonna color code our short term as blue. So I'm coming over here and connecting the lower band of clustering areas. So our short term in this example will be highlighted as blue. So the first auction zone that I have got identified intraday on Netflix is this one here. Let me just do this. We will duplicate that and we will pull it up to, again, we want to not, I'm not going to use this because that's in a longer term zone. I'm going to pull it up to a clustering area outside of that longer term zone. And it just so happens to cross through the top end of this clustering stuff in here. So that I don't want to, you know, purposely pull this there. All right, now that is going to be the distance in our short term. So let's come over here, do this number, come up here, activate that, and duplicate this. Whoa, do you see that? Do you see last Thursday what happened here? Last Thursday and last Wednesday. Do you see that? Right into our short-term zone. Right into our short-term zone. Do you see that, Glenn? Glenn requested this one. Do you guys see that? Okay, let me build one more layer to this. So, as it stands, we are between zones. You and I have no idea of knowing if it's going to come back down to this one before it goes up to this one. And we have no idea of knowing if it goes up to this one, if it's then going to crash through and go 5 layers down and find support 1 on 5 layers down. All we know is that this is where your price will at least pause temporarily, and you see it beautifully. Boom, right there, touch, resist, okay? You see it here, vertical, resist, vertical, resist, vertical, resist. It broke out, opened here, and went on, okay? All we know is that this is where price should resist if it's below and coming up into one, and should find support if we're above. Let's go out 180 days, and let's just extend these to the left and see these shorter term algorithm, these shorter term auctions are always working the longer term. Look at this, folks. Support, support, resistance, resistance right in there. Support, support, okay, support right in there. As we go back, support right in that one. Okay, came down, support right in here generally, right? Yeah, we came down in here and it got a little bit, again, every peak and trough, you know, again, there's sometimes where it goes past an auction zone and it V bottoms because it's out of an area where it wants to do business. But most of your zone, here's your longer term one right there. Okay, came in, found support on a shorter term one, bounced, went through that one, went to a longer term one and our shorter term one. Where'd it go up to? Shorter term auction zone. Where'd it go down to? Longer term auction zone. Where'd it go up to? Short term auction zone. Short term auction zone resistance. Resistance. Short term auction zone support, which is also within our longer term one. Short term auction zone resistance. The market is predictable, folks, and it is algorithmic, and institutions are the ones that move it. You would be best served by following them. That is the highest, most probable way of you achieving consistent, predictable success. Again, you may not get to a point to where you're doing $69 million per day, but how about $50,000 a month? Joseph is nobody different than any of you. He doesn't manage a big fund. He didn't have a ton of money, okay? But a little account grows to a large account when you have a predictable process. He sent me his results, and just look at this. I mean, he didn't just build it. It took him some time. It took him 18 months to grow his account to a point to where it was able to give him these kinds of returns following this process. We're talking about an average monthly profit that exceeds your typical annual income of most Americans. He made $102,000 in a single month. This is kind of the upper, kind of middle class stuff. You will have no problems growing your wealth and realizing some pretty incredible returns if you will just follow institutional zones. Glenn said, show me intraday. We use this intraday process with our retail group twice a week. This is one day applying this process on an intraday chart. And this is not a multi-million-dollar account. This is a, before the day started, $180,000 account. So if you're not realizing consistent, predictable results, there's a path for you to do that. And in my opinion, there's no greater path for you to pursue than getting on board and following these guys, following the smart money. We've made it our mission to do that at not just the Super Trader, but also at our fund. When we started doing this, people would pay us over $16,000 to get them set up on following this because it's an investment that works. And we don't do that nowadays. We've streamlined things to give access to the masses, no matter where you're at. Obviously, not many people can get access to something, even if it works, they just simply cannot afford something like that. But you can see why people have done that, because the process works. It's predictable. And we've applied that in our group now for going on 7 years. And our outcomes are exactly, I showed you a reward to risk ratio of 70% and 1.5. Using this methodology of auction zones in this 7-year period of time, we have kept these metrics aligned almost perfectly because we're systematic and rules-based at following institutions. It's not a guesswork. We're not looking for the next greatest trinket. We're just following institutions. The results are phenomenal, but you just have to follow institutions and stop making it as difficult as what you're making it on yourself. Even if you've never had success, folks, this will work for you because this is how the big institutions operate, and this outlines that. So, how can I help? What we've done in connection with Investors Expo is we've set aside some time over the next 48 hours to speak with you personally about how you can apply these ideas to your trading today. Whatever your challenges, we've seen them and we know how to overcome them. You're not going to find a lot of organizations out there that are both on the institutional side and have something where they're guiding retail self-directed investors on an institutionally quality system. On this one-on-one session, what we will do is we will help you craft a step-by-step game plan to hit your income goals for the year, whether that's $10,000 a month or $200,000 a month. And a lot of you don't realize how low below your capability you really are. Again, this is just one day using this methodology in our trade room. On an account that's not multiple millions. Here's another day, $51,000 in a day, not on an account that is worth multiple millions. So whether your income goals are $10,000 or $200,000 a month, we can help you craft a plan to achieve the goals that you've got set and become a master at getting in and out of positions at the right time. The cost of this call is absolutely free, but it's not for everybody. And those of you that it's not for, I would ask you to respectfully not do this right now. You must have already taken some stock market related training on stocks, options, or others and are still struggling to find consistent, predictable success. If you're just starting out, I will be in contact with you and give you some resources to advance your training with basic stuff. You have had to already gone through training and are still struggling. We are not in a position where we're able to help those learn basics. On this call, again, we've got 8 slots open. If you book one, show up, because you're taking one from somebody else. There's a massive audience here today that may really need this. So hold yourself to the highest standards of integrity and show up on this call. So if you're still struggling and you've got experience and you're not just brand new, book a session now. I'm going to give you the link in the chat right now to do that. Okay. Go to thesupertrader.com/chat to book that now. We've got 8 slots open. So on this, you'll book your slot. And let me just tell you why we're doing this. We're doing this because, first of all, I really don't like this industry of teaching people how to trade. I think that it is an industry where people take advantage of people's hopes and dreams and sell them junk. So first of all, we're doing this because I really loathe this industry of a lot of people selling a bunch of junk and taking advantage of people's, hopes and dreams, and they just don't have institutional quality systems. So I like giving back, and I like providing something that actually is systematic and institutional grade. Plus, we know that you might want our help to transform your trading. And as we outline this plan for you to move forward using this process, if you want to explore working with us and what that looks like, we can discuss that on that call. And if you don't, that's fine too. So I've put the link in the chat, thesupertrader.com/chat, thesupertrader.com/chat. Yeah, we've got 8 slots available. So go and book your session right now. After you do this, you'll be given a questionnaire where we will find out a little bit about what you've been doing. And then I will be calling. I'll call you. I will be calling you personally for that chat. Folks, it has been a pleasure to spend some time with you here today. If you've gotten nothing out of this other than seeing how predictable these peaks and troughs really are, then I've done my job. This is predictable, and you can predict it and participate in that and finally have consistency. You just have to get in line with the folks that move things, and we can help you to do that. For those of you that stuck around with me until the very end, you can use this second link that I am putting in the chat. Let me know if you're seeing it. thesupertrader.com/analytics-tool-download. Let me know if you're seeing it. And you should be able to get that link. Okay, awesome, Brad. Thank you, you guys. Great, you guys see it. All right, so I've got, let's see here. We've got Raymond, we've got Mohammed, and I know these, so we're down to 6 slots left for this one-on-one, folks. If you want to hop on that and dive into this and explore, Paul, I got you. Go ahead and do that right now. So we've got 5 slots left. It's been a pleasure spending time with you guys here today. And hopefully you view that as time well spent. I honor the time that you've given and hope that in some way that you have gotten tremendous value out of that. If you do have questions, you're more than welcome. If you don't schedule a one-on-one, feel free to reach out to me personally, nick@thesupertrader.com, or my personal email, nick.lovelace@gmail.com. Either one of those. You'd rather send me a text message, 872-395-1664. You guys have a wonderful, wonderful rest of your day. Wayne, I've got you scheduled. There's 4 more spots open, folks. Go and book that right now. And let's help you to apply this method and get to where you have been wanting to be. Absolutely, Brad. Thank you, sir. Thank you for all the interaction. Vish, I've got you scheduled. We've got 3 more slots open. So do that now. I'm going to be done now, folks. Have a wonderful rest of your day. That's going to do it from me here. And if we see each other again, I'll look forward to it. Otherwise, till next time, trade super.